insight, where I am coming to you from John's condo down in Naples. So very festive on vacation. Can't wait to get back out in the sun. But apparently we brought the cold weather down with us. It is only about 70 degrees as a high today. So I'm sure it's upsetting to you, Chris. We did not get out and avoid the snow, so my 8-year-old is very happy. I'll try to keep my voice down a little bit because I got an 11-month-old over in the next room trying to sleep. But we're going to be trying a new format. So Chris is joining me. Chris, how are you doing?
Doing great. Stole your office for this call.
Maybe we're like 3 or 4 years ahead. So I moved down to Naples with John. You take over in the office and in St. Louis and just man the fort. So I'm going to go ahead and we're going to try a little bit different format. I'm going to jump down to slide 4, which is just the price points that we talk about in the market. We talked about 4,600 as a key area where we'd start to give a sigh of relief. We haven't hit that yet. What are your thoughts, Chris?
Getting close though. The market's been improving. S&P 500 still around that 5% pullback. Nasdaq flirting around correction still, but improving.
And then we moved down to the 10-year. How surprising is that movement?
Not surprising at all. The market maybe people would have thought would have been a little bit more scared. The 10-year Treasury yield was up to almost 2% yesterday in the 1.96 range. Right now it's a little bit lower than that, and we didn't get a big sell off from that with rates rising, which has happened in the past. It looks like the equity market is pricing in these increase in rates nicely, at least for now.
Yeah, for now, they certainly have been pricing it in, and we haven't seen a lot of the volatility, which is a good thing. I think a lot of it has to do with just the expectations of the Fed and kind of being a little bit. They put their hawk cloak over the dove like last week, whenever we're talking about.
Right. And we have a CPI number coming this week, I believe tomorrow. And as always, for the past 6, 7 months, everyone's claiming it's the most important CPI print, at least until next month. Um, because it is on the heels, getting ready for the Fed to start increasing rates. If a surprise to the downside and there's not as much inflation, they may reconsider that, be very bullish.
It's a very bipolar market, right? And then we have peak earnings. We talked about peak earnings, and we're looking at the different sectors with a lot of sectors actually, whenever we look in aggregate, are beating the estimates. What are your thoughts?
Yeah, looking at the middle here, the S&P 500 is in the middle. We're coming in right at that 76%. That's the average beat rate over the last 5 years. So nothing spectacular here. The mega caps have done pretty well. We did have big miss with Facebook and their user growth, but information technology, that's the second from the left, 85% beat. So things are looking a little bit better for technology.
Right, and that's been the sector that's probably had the roughest patch since really December. I was going to say beginning of the year, but really since December, as these rate hikes were starting to be talked about. What's surprising to me, and I want to dig into it, is to see materials really kind of miss, even though industrials are up, and it just makes me wonder if a lot of that inflation that we're seeing is actually squeezing the margins of basic material companies. So like anything, this is an aggregate. You got to get into the details and actually find out why that's showing up. And then the next slide, we're kind of looking at just the earnings growth rate, if I remember right here on this.
Yeah, we're looking at earnings estimates from analysts, and we're looking at the change in those estimates. So a lot of times, you get through some earnings season that these are trailing, right? So we're getting earnings from Q4 of last year, and they're taking into consideration those earnings and guidance for where they think the next quarter is going to be. And they've actually decreased their earnings a little bit. Is it substantial? Not really. It's not uncommon either. Looking back to the beginning of the chart in 2018, there were a lot of downward revisions, but it did, snap the streak of constant beat and raise and kept earning since really COVID of March of 2020.
Now, one of the places people have been trying to hide out, where you kind of get this free lunch, you get high returns, low volatility, just continues to move on, is ESG investing. It's certainly a heavily marketed strategy, and we've had people ask for it. We don't have a specific ESG strategy that we manage, but we do offer one that's more of a passive approach for clients that do want to engage in ESG investing. Can you give us an explanation of this chart?
Yeah, and then hopefully over the next 5 or 10 minutes, give you an explanation of why we don't offer the strategy, because we think it's full of a little bit too much hype that's unlikely to pan out. But people are asking for it, and you can see with this chart, it's growing, and we think it's probably going to be here for a while. So it's worth addressing in a little bit more detail.
Yeah,
Um,
this chart is mainly showing the flows of money going into these individual strategies. So why don't you tell us what the E and the S and the G actually
yeah,
mean? And
so the CFA did a survey on this on this next slide here, and they asked both equity and fixed income analysts, and they said, "Are you considering environmental, social, or governance (ESG) when you're making decisions?" 56% of equity analysts said, "Yeah, they're considering governance," and a little bit less, about 1/3, for environmental and social issues. So governance is clearly the most common. Um, but it also gets into really a measurement problem, which is how do you quantify ESG? If you ask these analysts what they're looking for, you'll probably get a dozen different responses. Or if I ask you, you're going to give something different than what I say for governance. So, what are you looking for in terms of governance, if at
yeah,
all?
if I'm looking at governance, I want to know how the company is governed, and it's not going to be oftentimes what other people are looking at. So the diversity, inclusion, and equality component. I want to know how are dividends being treated. What's the kind of the views of the board. Do they fall under stakeholder capitalism, or are they back to the Milton Friedman? The point of a company is to try to get highest valuation. And I think the big difference is the way that I see profitability. It oftentimes is a negative connotation on profits, but profits are just the measurement of values that people are attributing to whatever product that is being developed. So I think profitability actually incorporates all of these factors. I mean, governance is important, but it's kind of one of those squishy terms that you really need to define on what you mean by governance. And a lot of times there's a lot of politics and specific narratives that get painted in that. So you really want to understand how somebody is classifying governance. But it's not just governance that's hard to measure. If you look at the environmental impact of a company, you're going to look at and say Google, how much environmental impact? Well, if you look at their income statement, their expenses, it's a web browser, and they do advertisement. You're not producing oil. You're not actually even using much oil at the company level. But how many users are actually on the internet using their functionality, using their different products, all of which consume energy in some form or fashion on a computer that's using a lot of plastics, a lot of silicon. All of those things are also, hopefully that blender isn't getting picked up in the background.
Oh, it
But
is. It
no, it
is.
is. It's nice. So it is an ESG friendly blender, so it'll fit right in here. So the environmental impact of using all these different web browsers and other things that takes energy, but that isn't getting calculated. So depending on how a company is structured, could hide a lot of the impact that they're having if you're not measuring for those impacts. And then social issues, well, they're social issues. They're different cultures, different views, different things. Whose lens are you measuring this through? I think those are important questions to understand.
Right. So those problems, of course, are not going to stop sell-side researchers from creating a score. They're going to create an ESG score the same way they'll create a overvalued, undervalued score for a stock and say, here's our criteria, here's our ESG. So on our next slide here, we're showing 6 stocks and 3 different rating agencies. And you'll see the correlation is not very high here. These squares are all over the place, with the exception of maybe JP Morgan, where they kind of agree, but the other ones are kind of dispersed. And what it makes me think is, if these rating agencies can't even agree on 6 blue chips, how are they going to start agreeing once we start moving out into some smaller stocks?
Right. Yeah. It is all over the place. I almost feel like I'm looking at sheet music, not a consideration of what is ESG.
Right. When they
So,
did another study, did a correlation rating, and they said, all right, ESG across these companies, there was a correlation of zero point 0.5. So it's not a high correlation, it's not really low. That was the full ESG. But what we talked about earlier with governance, which is even harder to describe, the correlation was zero point 0.2 on governance, so extremely low. Um,
I would say no correlation.
they're measuring different things, so it's hard. And the counter argument would be, well, we're early, right? ESG, well, sustainability's been around for a while. The new ESG movement hasn't been around that long, so maybe they're just getting used to it. But um, I think it's going to continue. It's too hard to measure this.
So then, how should you be valuing a company, or taking this
Well,
stuff into
well,
consideration?
I before getting into that, I just wanted to stop and say, if you're investing in ESG because you like it and you feel good and you think you're doing good, really stops here for you. You're done. I have no problem with that. I don't think you do either. You've made no claims on performance of a company. You just feel like you're giving back. The problem we have when it comes to ESG is it's often pitched as the silver bullet. You get higher returns, lower risk. The company can give away money and be rewarded with higher stock prices. But we don't really see that in the data. The market's not dumb. If you're giving away money, they know they no longer have that money. It was the shareholders' dollars that they're giving out. So, in order to meet any of our silver bullet criteria, we have to pull up a equation that we pull up all the time. It's a value function, free cash flow, growth, and risk. So, in order to add value as ESG, you have to find a way to come up in this equation. You have to either increase your cash flows, increase your growth, or decrease your risk. We can make the equation even more complicated by adding in a few more items. And this is really where we can actually look into some academic papers and say, well, what have we done here? So for growth and reinvestment, you obviously have to reinvest if you want to grow. None of the data show anything with a positive correlation between ESG and growth rates. And I know a lot of people will say, well, what about, green energy? They have great avenues for growth, but that really gets into more of a sector specific value. That's not really ESG. You have growth avenues in a sector. It's not, the same thing if a retailer wanted to get into growth by ESG. There's just no correlation with extra growth.
Right, and a lot of times that growth is, you're like, well, solar power. Look at how small it is as a market share relative to the entire energy sector. It's a very competitive industry, the broad energy, and I don't know that it necessarily has to have a competitive advantage. And even if you have one, if its size could just as easily be a bear argument for it, right? If I say, well, look at how much retail Amazon has, and I'm going to come out here and I'm going to start my own thing and it's just going to grow, and I'm going to take over all their market share. Well, Amazon's probably going to clobber me because they have a lot of clout, a lot of capital. So I don't know that just because you're starting out and the growth potential is huge, that necessarily means that you're going to win.
Right. And we didn't say it earlier, but it's hard to measure. It's easy to measure something like industry sector or size. Do you know if small or large caps tend to do better on ESG ratings?
I don't know that. My guess is large has done better historically.
It has, and people give all different reasons. And what I think after reading the data is large companies have better ESG ratings because they have a better chance, more likely that they're profitable, and their profitability gives them the ability to then go do goodness ESG with some of their profits, while a smaller company can't do that.
Yeah, it's kind of like the cart before the horse type of thing. A lot of people, especially like a Keynesian economist, will say, look, all the very wealthy areas tend to have progressive policies. Well, one explanation is progressive policies make you wealthy. Well, if that was true, then you just need to pass a bunch of progressive policies and everywhere in the world would be wealthy. It's probably the other way around. Wealth allows for the ability to pay for progressive policies. So the wealthier you are, people are, and the reason I'm not too hip on ESG or not too concerned about the impact is I think most individuals that are engaged in the market have high values and shared values. So most of humanity shares a value of helping out, and they will favor progressive policies while they can afford them. And I just think that's a similar component here. And that kind of gets us into what is actually driving ESG performance over the last, let's say, 5-10 years. Well, the companies that will have the highest ESG ratings will tend to be companies that look like large tech companies. Right?
Yeah.
Because what we were saying about Google, they don't have to actually attribute all the energy consumption that's being used for that. And if you think Bitcoin uses a lot of energy, I promise you Google and the internet is using a lot more than Bitcoin, because it's just a small portion of the overall internet world.
So you're not screening it out for environmental reasons.
Right. Maybe you should be whenever you look at the amount of energy consumption. So then, what are the kind of 3 areas that the academic studies really covering?
Yeah, the academic studies show that there's probably 3 areas where value can be added, maybe 2, and the third is kind of hard to see. And that's profitability, risk, which comes into your cost of capital, and then failure risk. So the best piece that we reviewed 250 studies. It was from WashU and Harvard, and they concluded that doing good, so actively seeking out, some of this goodness ESG, had an overall impact, and it did improve the business, but it was really small. So again, this gets us back to, making money, allowing you to do good, or to do good, allow you to make more money. But they did find that there was some evidence for the profitability. So we want to acknowledge that at least it's out there. There's a lot better evidence for the cost of funding. So this is that discount rate. That's the rate on the bottom of the equation. A higher rate will then give you a lower value. And what the studies showed is they didn't really show that goodness was rewarded, but they showed that doing bad was punished. So vice stocks, your alcohol, tobacco, firearms, they're not widely held by institutions, and that gives them a higher cost of funding. If they need cash, they have to offer shareholders a higher return, therefore higher discounts. But this also kind of brings in the caveat of ESG that we talk about all the time when it comes to fossil fuels, is if the market's wrong. And you talk about it all the time with what is the market projecting for fossil fuel consumption 10, 15 years from now. If the market's wrong, you're going to have a higher return in these higher cost, higher funded fossil fuel companies.
Yeah, it's kind of changing here, but whenever we're looking at the overall market share that energy, specifically oil companies, take over the S&P 500, it got down to about 2%. Now, this is a sector that used to be the largest sector, and to me, I just think that that's too far, too fast. I don't think it'll be the most valuable sector again, and I do think a lot of the green energy that we will eventually have to replace oil as a primary energy. We won't run out of it because the cost of it will get too high before we run out of it. So there's got to be other alternatives for energy. They're coming. It's just probably a little too early to really scratch them out. And then you got to talk about just all the other items that come from energy, our plastics, the petrochemical industry. It's not just about moving vehicles. I think it's a little too soon, and we're banking on green energy that's not yet reliable enough to really offset some of these things. So I think oil will be with us for quite some time, and it will thankfully be replaced over time. It's just as money has flowed in the ESG, and a lot of these really speculative investments start to slow down, I think energy is going to reassert itself, oil specifically. Once again, this is not to say you should go buy oil and only oil, and that the market's crazy with all of these other things, because we will have to find an alternative. But it's going to take decades, not just a handful of years.
The final case we really looked at was disaster risk, and they looked at past reactions, not necessarily future predictions, but they wanted to try to get a negative screen. So they created a hypothetical portfolio based on bad actors and wanted to know, has the market underreacted to some past poor events? And they think they did, because this portfolio continued to underperform. It's kind of similar to what's called a negative screen. It's really nothing new to ESG. It's always been the case that if you avoid the poorest performers in the index, you have a good shot at beating the index. If you avoided GE the last decade, well, it was still weighted in the S&P, but not in your portfolio. That's a good thing. So the only thing that's really changed here is trying to identify the poor performers now instead of doing some sort of discounted cash flow. Well, now maybe you're looking at some ESG screen.
Right, and I think this is actually a part of something that we use as an overall screen. Has nothing to do with ESG. It's just measuring momentum, right? Companies that did perform better oftentimes will continue to perform better, and then vice versa. Companies that did underperform will continue to underperform until there's a significant catalyst to change that story. And this is something that we are measuring day in, day out, and will be acting on in the strategies that are not taxed on their trades. So this is just another way of thinking about momentum, where the market will find things that are doing well and will reward them, and they tend to continue to have that reward. But it's a momentum factor that is a premium that we can measure. And I think that's what happened with ESG. Once again, going back to technology, we've been heavy technology. We're not looking at it through an ESG lens. We're looking at it a momentum screen. So I think your ESG investing has done well because it's tended to push you into technology stocks, and technology stocks have done well over the last really decade.
Yeah. So really concluding on what we see in the data is really just avoiding the bad companies is likely a good thing, and whether that comes from ESG or elsewhere, but trying to seek out those doing good, that is less likely to be a winning strategy because it's expensive to do good. You have to spend a lot of shareholder dollars.
Well, but at some point there also is that doing good is like, it's a good thing that we reward companies that do good, and that's, I don't think it's I guess I'm not as cynical or pessimistic about human nature, because I think we tend to look for companies that do share our values and do things that we appreciate, and we will punish them for the most part if they do things that don't align with majority values. And I do think that doing good is a good strategy long term, but you also want to stay within the area that you provide the most value. You don't want to do good in areas that you're really not an expert in, and sometimes that can be a drag on cash flows. But if you're Google and your profit margins and all the other things are doing very, very well, and it doesn't take much, you do have a lot of excess revenue, so you have capital that you could put to use elsewhere. Is that the best and most efficient use? I think you can make an argument yes and no. I think you can go either way depending on how they're being used.
Right.
Well,
The old model is give money back to shareholders, let them choose how they want to spend it. Kind of the new evolving model is let the C-suite decide what to do for your values. And just to close it out, we have we think performance is going to matter. In this study that IBD did, this survey, 60% of people are still saying they care about investing. And I think a lot of people have been sold this idea that you can invest in ESG, get high returns. They've been right so far. You've gotten high returns, like we said. Was it from ESG or from sector exposure or some other market premium? When that reverses, will we still see this huge demand for ESG? I don't think so.
I agree with you, but I do also that values investing, not value, but values investing, has been around for a long time. Catholic community has written out processes and procedures in the way that you should think of investing. The Islamic community also has those things. But the thing that I like about those types that's just not yet developed with ESG is there's a shared value system that's articulated and very thorough within a worldview that you're investing in, where ESG is still too new, and there's also too many different divergence on what is meant by it. So I don't think it has the same long-lasting impact of investor values that some of the other values investing has historically been able to provide. Well, that's we're getting near the end. Go
I
ahead.
was just gonna say it may have its place if it does start to decrease as something that's rotating in and out of favor, just like any other sector. We're kind of starting to see that with innovation. That really wasn't necessarily considered its own sector years ago, but now, while we're seeing these outflows come out of those ARC funds that we talked about and we've held in the past, it's probably going to become in the future just sector rotation as people use them for short-term sector exposure.
Sure, absolutely. Well, that gets us near the end. And if you're watching us on YouTube and not the live version, this is pretty much where we cut off. So if you haven't subscribed yet, go ahead and click that subscribe button. Share us with your friends by hitting that arrow button and share it out. And if you enjoyed this conversation, hit the like button. If you want the live content, make sure you reach out with the information on the screen to get added to our text message that sends out the live link so that you'll be able to stick around and hear what is said in the live version and not just what is kept on YouTube.